Welcome to the course Stock Pairs Trading Strategy. Before we begin, please note that this course is for educational purposes only. The following disclaimer applies. The information provided in this course and related materials is for educational and informational purposes only and should not be construed as financial or investment advice. We make no representations as to the accuracy, completeness, suitability, or validity of any information presented, and we will not be liable for any losses or damages resulting from its use. Always consult with a qualified financial advisor before making any investment decisions. Trading involves significant risk and may not be suitable for everyone. Let's start by understanding the different types of activities in the financial markets. I began my journey with long-term investing, later experimented with swing trading, and even tried some intraday trading. On this table, you can see a simple comparison between the main trading styles: investing, swing trading, day trading, and pairs trading. Each method differs mainly in holding period, risk level, and the amount of time and attention it requires. Long-term investing usually involves holding positions for months or even years, with relatively lower risk and less daily involvement. Swing trading focuses on taking advantage of market moves that last from a few days to a few weeks. Day trading is much more active. Positions are opened and closed within the same day, demanding constant focus and fast decision-making. Finally, pairs trading, the main topic of this course, is a market-neutral strategy where we trade two correlated assets simultaneously. Eventually, I focused on pairs trading, which became my main area of expertise. Still, I continue to maintain a portfolio of long-term investments alongside my pairs trading activity. In my opinion, the best way to approach the markets is to start from the lower risk methods, build a solid foundation, and gradually increase exposure as your experience and confidence grow. So what exactly is pairs trading? It's a market-neutral strategy that involves two assets, usually two stocks, that behave in a very similar way over time. In the lower charts, you can see how each stock moves individually, while the top chart shows how they move relative to each other. We look for moments where their movements diverge, meaning one stock moves too far away from the other. The assumption is that, statistically, they will revert to their historical relationship. Our profit comes during that correction period. To achieve this, we open two opposite positions, one long and one short, because we don't know which stock will move back toward the mean first, the one that went up too much or the one that dropped too much. Looking at the lower charts, it's very clear that both stocks move in a similar way most of the time. But if you look at the blue rectangle, you'll notice that on one particular day, one stock closed green while the other closed red. That small divergence was enough to trigger my indicator, signaling a potential trading opportunity. You can see the entry point of the trade highlighted inside the purple ellipse at the top chart. The trigger will always occur when the relative movement, meaning the top chart, closes outside of the Bollinger Bands. If the close is above the upper band, as in this case, we estimate it will decrease back toward the mean. The indicator uses much more than just one day of opposite movement between the two stocks. And as you can see next to the purple arrows, although there are other spots where the closing price was also outside the Bollinger Bands, you don't see the indicator appearing at those points. That's because it also checks for correlation, z-score, and several other statistical calculations, all processed automatically by the computer, which then produces the signal you see inside the purple ellipse. There are two main types of pairs trading: stock pairs and currency pairs. I personally chose to focus on stocks for two main reasons. First, stocks usually show higher volatility, which allows trades to complete faster. Second, it's easier to understand why a statistical deviation occurred, for example, due to company-specific events, rather than macroeconomic or political factors, which often affect currency markets. Another important point for beginners: currency trading usually requires larger margin deposits because regulators view it as riskier compared to stock trading.